Hi, I'm Larry Berman, and this is what's on my radar this week. Biggest rebalancing in the Dow Jones Industrial Average in years, and index rebalancing and chasing has been a big factor for markets. Stocks like Tesla, stocks like Apple, which announced last month a huge 4-for-1 split. So Apple trading at $500 is going to be split on Monday to trade at approximately $125 a share. That reduces Apple's exposure in the Dow Jones Industrial Average by 75%. So in response to that big impact on the indexes, because if Apple's going to be reduced, every other stock's going to be bumped. What the index committee decided this week was to remove three older school type stocks and replace them with three newer school type stocks. ExxonMobil, long standing member of the Dow Jones Industrial Average, is being put out. Pfizer, big pharmaceutical company, being put out. And Raytheon, obviously an industrial but focused on the military side of things, being put out. Those three are going to be replaced by Salesforce, which is going to be add to the technology weight in the index, of course. Amgen, replacing the biotech exposure of Pfizer, which is more of a mature pharma company. And of course, Honeywell, which is an industrial, replacing Raytheon, which is again an industrial but more of a military shift. So we're going to see a bump in healthcare weighting go up as the stocks coming in are higher priced values than the stocks going out. For those of you playing the Dow that are playing it because you like the big tech exposure, maybe it's time for a rethink. Chairman Powell spoke this week about the change in the Fed focus to wanting and allowing, at least on a temporary basis, more inflation. If you look at a long-term chart of the personal consumption deflator of GDP, that's the inflation rate that the government factors into the growth numbers. For the last 20 years or so, the Fed has had a very hard time trying to reach their 2% target on average. But if you go back to the 60s and 70s and remember the double-digit inflation rates, the mandate of the Fed back then with Paul Volcker and Alan Greenspan were to control inflation. And now that inflation's been largely controlled for 20 years, you now have them seeking inflation. In fact, low inflation seems to be a problem for the Fed. And not a couple hours after Chairman Powell was finished speaking, did we hear from Dallas Fed President Robert Kaplan when asked a question by Steve Leisman in one of the Q&As why the Fed was buying the bonds of Apple and other large cap companies that clearly don't need the support from the central bank. His answer was, well, markets have to learn to live without the Fed support at some point, and that support for corporate bonds is going to roll off in December. On the bear side, looking at what should be on your radar now, looking into year end, if the support for credit is going to be backed away by the Fed and maybe not come back until we have a market shock, then shorting high yield bonds in the US might be something of interest, because where credit spreads are today is clearly not a reflection of what the likely bankruptcy rate's going to be in some of these high yield bonds. So by shorting JNK, HYG, or a long position in SJB, which is an inverse play, single inverse play, on shorting the US high yield market. And on the bullish side, again, coming off the Fed's acceptance of more inflation into the system, there's a very innovative ETF that was launched about a year ago, ticker symbol IVOL. It's the Quadratic Interest Rate Volatility and Inflation Hedge. It owns inflation index bonds, and it owns some derivatives that give you exposure to a steepening yield curve, i.e. rising longer term rates as the Fed is more tolerant of inflation while they keep the front end anchored. Well, that's it for this week. Thanks for watching, everyone. Hope you have a good week. And remember, subscribe to the YouTube channel, Larry Berman Official, and make sure you click alerts so that you know when we have new content out.